Your average person doesn't know how the wealthy get wealthy.
Adam Williams, welcome.
Thank you so much.
You've really set up a structure that takes the learning out of the process of real estate.
My number one goal is to teach people and squash all the misconceptions around money and bullshit, and that you have to stay broke or that you have to struggle, because you just don't.
What are the misconceptions in real estate that people have?
The most common misconception in real estate is
each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
We're back on Money Isn't, and I am really excited today for my guest, Adam Williams. Welcome.
Thank you so much for the invite.
We're going to dive into an area that everybody wants to be involved in. So many people enter it with the wrong rules, the wrong vision. They lose money. They don't optimize. And it's the real estate space.
Yeah.
And you've been in the industry for how long now?
Just over 2 decades now.
Okay. Yeah. And you started, when I read your background, it seemed to be you were more like, it was a different deal flow. So talk about where you started.
Yeah, it's really interesting. I fell into it by mistake. I mean, going all the way back to my childhood, my dad was a slumlord and not a successful one. So he didn't have some beautiful, shiny buildings, and didn't make millions and billions of dollars in real estate. But he had a couple of residential
Where'd you grow up?
I grew up in Vancouver, Washington, right next door to Portland, Oregon.
Yeah, sure.
And so as a little kid, as early as I can remember, I would go to these, he had a little 5-unit apartment building in not such a nice part of town. And I would go to these apartments and help him collect rents and clean them out and this and that. So he always kind of hammered in my head, you need to get into real estate. But like all teenagers and young 20s.
But it looked like crap to you.
Yeah.
It was like a slumlord, and you're cleaning out ugly stuff. It was not.
Literally, I would help him move out furniture when people would, part in the middle of the night and not pay their rent, and cockroaches would scatter everywhere. So not the type of thing I wanted to. Those were my earliest real estate memories.
Interesting.
And so, I kind of went on in my teen years and my early 20 years trying to figure out my own entrepreneurial, building this business, a detail shop and a this and a that, and nothing that worked. And he kept hammering in my head, you need to get into real estate. You need to get into real estate, whatever. And I was invited to a Halloween party. And I went to this Halloween party. I knew the person that invited me was a friend, but I didn't know the guy that owned the house. And I pull up to this Halloween party. And the house was the biggest house I'd ever seen. It wrapped around the whole corner of this mountain, and it just seemed to keep going. And I was like, oh my God, like, who is this and what do they do?
Yeah, right.
And so I walked up to the house, knocked on the door, and the guy that invited me, my buddy, answered the door, and he introduced me to the owner of the house. And I'm about 25, 26 at that time, years old. And this kid's 18. And I instantly said, what do you do and how can I get involved? Something's going on here.
I'm doing something wrong.
Yeah, like, are you a cartel? What are you doing?
Drugs.
Yeah, what is it? You got a prostitution ring, poker room in the basement. And he said, no, I invest in real estate. And
at 18.
At 18. And he actually owned a mortgage company. But he said, that's not how I make my money. I invest in real estate. And I said, okay, cool. I'm going to enjoy the party, but Monday I want to come see you. I got to see what you're doing. And I did. He gave me his card. I went to his office Monday. And he said, I'm buying a lot of like foreclosure, pre-foreclosure, Liz pendants, notice of default. I'm buying some deals off like the tax steps for like tax default and stuff like that.
Tax liens and stuff like that.
Yeah, tax liens.
Yeah.
All single family. No commercial. And I said, cool, how can I get involved? I was a marketing guy. I owned a little marketing company, thought I knew what I was doing. I really didn't. And he handed me this giant stack of papers out of the printer. It was probably an inch thick or so, which just full of like all the notice of defaults from all the title companies that had come in maybe that month or whatever, And it was thousands of names, addresses, phone numbers. He goes, I want you to go home. I want you to call every one of these numbers on here. And I want you to book appointments for me to meet with them and see if they want help with their foreclosure situation. I said, sure, I can do that. I can call some people. I went home, started calling through this list. About day 3, and 1,000 FUs and hang-ups and don't ever call me again. And
don't come near me, you scumbag.
Yeah, you're a scumbag.
Yeah.
Later, I got 0 people that wanted to talk to me.
Interesting.
And so I said, there's got to be a better way. So I didn't have a lot of money at the time. I was struggling financially, and I went and I took like the last $300 in cash that I had, and I bought couple rolls of stamps, which at the time you could afford for a few $100, and a big box. Remember like the Office Depot, and you'd buy that big box of envelopes?
Sure.
And then some paper and some printer ink. And I went home and I typed up this little letter, and I hand wrote every envelope because I had their addresses on this list. And I mailed out as many as I could with that $300. And I got a few people that started calling me and said,
What did the letter say?
the letter basically said, hey, I see that you're having some trouble with your home. Looks like it's going to go into auction soon. You know, they're going to take it from you. We can help you. And if you want some help, give me a call. It was super simple. One page.
Beautiful.
Super simple.
Beautiful.
And
Beautiful.
Phone started ringing. I probably talked to 9 or 10, 12 people. I don't remember. And I got one deal. And out of that deal, I made $9,000. And I thought I was rich.
Yeah.
I said, dude, I've never made this. I've never seen a check for $9,000 at that point.
Did you mail again?
Yeah, I took all 9,000 and I went and bought as many more stamps and envelopes as I possibly could. So that was like my first in. And so what I did is I partnered with this guy because he was like, holy shit, you can bring me some deals, right?
Yeah.
And so we did a 75-25 partnership. He would do all the work. I would just do the marketing and set appointments for him. And we went on to do a little over 250 of those in just under 3 years. And it was my first into kind of figuring out, and I built a rental portfolio during that time. I acquired a bunch of them myself. We did a bunch of, we would get them, and then we would, some of the ones we were buying off the tax steps, we met some realtor contacts that would wholesale them for us. So we, buy them for 40, sell them for 50 the same day, that type of stuff.
Beautiful.
So we did a lot of that. And then in 2007, I had a 70-seat call center. We had cranked up. Like we did 252 of these in under 3 years.
Yeah.
I'd cranked up this big call team and all these things. And I had 31 deals on the board when the banks decided they were going to stop lending money in one day. And so our business was gone instantly. But during that time.
But the problem is still there.
The problem is still
so
there.
The opportunity's bigger than it's ever been.
It was, but
no access to capital.
No access to capital. That business was pretty much done unless we had a bunch of capital, cash investors that could come in and do these things with us, and we did not.
Right. Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars.
But what I realized about halfway through that process was I was never going to get to where I wanted to go doing one house at a time. I have big goals. I wanted 10,000 doors in 10 years, and then I'm going to go sail off into the sunset on a big yacht. And like, that was my goal at, 28 years old or whatever I was.
I have a video like that. It's it's exactly like that. You're just going to sail off and sail
it's all
enjoy.
You have no fear, and the money's never going to stop coming when you're 27, 8 years old. You just, it,
it's
right?
beautiful.
And you know nothing, but you think you know it all.
And you should actually stay there because that's true, but it's all the other bad things that happen along the way that stop us from doing things.
It's all the hurdles that we don't know are coming that we got to figure out a way to jump over.
Right, and they're just hurdles.
Yeah, they're just hurdles. So so needless to say, just on my foray in real estate and how I kind of got where I am now, about halfway into that, about 150 deals in, I said, there's just no way I'm going to scale this thing. And I wanted to get out of the single family space anyways. And I got tired of sitting on people's couches, and they're emotional, right? They're losing their homes, and they're crying. And I care about people. I feel bad, and we couldn't help them all, and blah, blah, blah. But so I paid a guy down here in Arizona. This was before masterminds existed. I paid a guy 20 grand. I found a guy that was like the biggest commercial multifamily real estate guy, and I paid him 20 grand to let me follow him around for a year and teach me everything he knew. And he did. And I just learned A to Z, how to find a property, how to underwrite a property, how to acquire it, how to renovate it, how to increase the NOI, how to decrease the expenses, how to sell it upstream, like all the things, the financing.
This is on the back end of that 07
Correct.
thing. So like your wife probably thought you were nuts.
Oh, yeah. I mean, I was always nuts in her eyes until it actually started making money.
Is he still nuts?
That's part of the fun.
Yeah, good. I just want to make sure. Okay, good.
I think we all got to be a little nuts.
You are, and that's the best thing about it. Like, you
mean,
wouldn't be sitting where you are if you weren't.
That's right. Yeah, you got to be a little nuts to come up with an idea that you think up in the shower or while you're sleeping or whatever, and then actually execute on it and bring it to fruition. I think you got to be a little crazy.
Right. So you have this vision. You find this guy. He's willing to do it. You follow him for a year.
Yeah.
Year and a half.
Yeah. And then I started investing in other operators, other sponsors, apartment deals, other funds, because I wasn't in a, still, even though I had the knowledge, I wasn't going to go out and raise $100 million. I had never done it before. I had no track record.
That was for somebody else.
Yeah. And so I just started investing my own money. I continued to run my marketing company. So I was making money at that point. And I started investing in other people's deals. And then I decided a few years ago, my amazing wife was running her own company completely outside of real estate for 10 years before we ever met. And she was doing very well, but her company was helped like form new businesses and entities. And she worked for a lot of law firms and stuff like that and CPA firms. And what happened is when COVID hit, her business was done pretty much, overnight, because nobody's starting new businesses when they're afraid they're going to die the next day.
Correct.
And my marketing business as well just went to a screeching halt. I had a big event company at the time and different things. And so we looked at each other and I said, let's go into real estate full time. Let's just screw it all, forget that stuff. And let's just we love working together. We love, we're partners in life and partners in business. So we formed a private equity multifamily real estate company called Elevest Capital. And our office is here in Scottsdale, Arizona. And we now solely raise capital for large multifamily syndications. And it's great because we get to be a part of the deal, but we don't have to handle every single piece of the deal. Okay. And I was telling you before we jumped in here to start filming, my number one goal in life, I'm 47 now, and my number one goal is to teach people and squash all the misconceptions around money and bullshit, and that you have to stay broke or that you have to struggle, because you just don't. And I think people do because they're not educated on how the wealthy get wealthy, right?
Well, let's spend a little time on that right now. What are some of the misconceptions that people should overcome?
Well, I think it takes the right person first and foremost, the right mindset, right? This is not a fit for everybody. Entrepreneurship is definitely not a fit for everybody. But it starts back in what we're taught, right? We're taught to go to school, get a good job, work for somebody else for 40 years, shut up, put money into your 401k that you have no visibility really into, you have no control, and retire with barely enough to get by, and you hope that your life runs out before your money does. That's what we're taught, right?
It's pretty dismal.
That's it.
Yeah.
But people love it.
Right?
They love it.
No, they don't.
They love it because they're miserable.
Right.
But they do it because they don't have to think for themselves for the most part. And I'm not speaking down on anybody. I appreciate everybody in this world, and everybody's trying to climb their own mountain their own way. But for the most part, that narrative teaches you that somebody tells me what to do, when to wake up, when I can go to the bathroom, when I can take a vacation, when I blah, blah, blah.
Yeah.
Right? All the things.
Yeah, you have lost complete control.
And
but
you've
it's
lost
sort of
complete
like,
control.
I'm okay with that.
But I'm okay because I don't have to think for myself. I don't have to take risks, which basically tells me that most people don't believe in themselves.
They don't.
And so
financially specifically.
Yeah.
Yeah.
And so my thoughts behind that, and we'd be here for hours, but my thoughts, I'm actually writing my first book right now.
You've got 3 hours right now. I'm just kidding.
I'm writing my first book right now called Built to Keep You Broke.
Built to Keep You Broke.
Built to Keep You Broke. And it's going to go in and it's going to squash all these common misconceptions and go into facts of how mortgages were created and why they're selling the dream on the white picket fence and you have to own a house and all the things.
Levittown, right?
Yeah. So we'll get into all that a few months from now when I'm back on your show and the book's out.
Good.
But basically, if you were of the mindset, everybody has an idea, right? Everybody. I don't care if you're a W-2 employee or if you're a serial entrepreneur. Everybody has an idea.
You sure do.
They see a thing and they're like, I could improve on that, or I should do this or create that. If you have an idea, don't quit your job because you got to pay your bills, but freaking act on it.
Right.
And you're probably going to fail. And you're probably going to fail the first 10 of those ideas that you act on.
Right.
That's okay. Because you're going to learn a little bit more every step of the way. Every time you fail, you're going to learn what happened. How could I have done it better? That hurdle that hit me in the face that I should have jumped over.
Yeah.
And I think, look, I've started probably 50 companies in my life and failed at 48 of them. But the couple that I won at, holy shit, let's go.
Let's go.
Right? And so that's really it.
And I think that's starting. I mean, people fail because they're afraid of the failure.
Yeah.
All right. So they don't actually start, but it's what you learn in the failure that I think shapes your future. And if you ignore the consequences and you keep going, like previous guest was talking about it, people were telling him to stop.
Yeah.
And he said he was too dumb to stop. I'm just going to work. I'm going to work through it.
Yeah.
And now he's got 3 amazing companies. And it's like, okay, So that spirit that you're trying to get people, so that they're in prison with the decisions that they made because of fear of failure, and that they try one thing and they fail, and it's like, oh, I got to go back.
Right.
What are the misconceptions in real estate that people have?
The most common misconception in real estate is, and a lot of our clients, they're high net worth individuals. They work, either they own a business and they make really good money,
Correct,
or they work a high paying W-2 job. And what happens is just what I've seen over and over is human nature is, once you start making enough money, you want to find a way to take some of that money and make that money start making you more money, right?
Yeah.
And turn
recurring income,
right. Take this
passive
active income that I'm earning every day in my day job or my business and move some of that into a passive income strategy. And first things first that comes to people's mind is real estate for the most part. Yeah. Cool. That's great.
Right.
The misconception is they think I got to go buy a single family rental, or I got to buy an Airbnb,
or I got to buy into a fund.
Yeah, and look, not many people, or a REIT or something, right?
Yeah.
But not many people think I can go get involved with this 200-unit apartment building and be truly passive. Most people think that they need to go buy a single family rental. I did it too for 2.5 years before I figured it out.
Sure.
I got to go buy this single family rental, and what happens is they inevitably lose money. Nine times out of 10, they lose money, because in a single family rental, I put 30% down or whatever I put down on it. And then I have this rental property, and then it takes me 2 or 3 months to get a tenant in there. And then when I get a tenant in there, that's awesome. I'm making $100 a month, maybe passive after everything's done. And then that tenant moves out a year later, and it takes me 2 more months, and I lost 5 years worth of cash flow.
Correct.
Or that tenant destroys the property or steals something, or the HVAC unit goes out, or on and on and on. And I lost 10 years worth of cash flow. I had a gentleman come into my office. He's become a friend now. He's invested in our last 3 or 4 deals. And he's a high net worth guy. He owns a company here in Scottsdale. And he said, Adam, and he'd already invested in a couple of our deals, so he knew the multifamily thing. He said, Adam, he goes, I want your opinion on something. I said, sure. His name's Chris. I said, sure, Chris, what's up? He said, I just bought my first single family rental home like right before I met you. And he said, it was a $550,000 home. I put $200,000 cash down on it because I wanted a good equity position in this house. I didn't want to owe a bunch of money on it. And I said, cool. I said, how much are you cash flowing on it? He said, cash flow? What's that? He said, I'm paying every month to keep that house. He said, here's what I want your advice on. He said, I'm thinking about, because I'm not cash flowing, I'm thinking about taking another $350,000, because he has the money, paying it off so I own it free and clear, so I can cash flow a couple grand a month on the house. Versus, I want your opinion if I should do that, or I should sell it, take that $550 cash, move it into these apartment syndication deals that you guys do, because he'd already done a few with us, so he's comfortable with us. And what makes more sense? And I said, let's just run the numbers.
Yeah.
Side by side, because it doesn't matter what my opinion is. Let's run the numbers. And we did. And if he would have paid that house off, it would have taken him 18.8 years to break even. And that's if he never lost a tenant, never fixed a roof, never fixed an HVAC, nothing. Nothing went wrong ever, which we know doesn't happen. Right.
So I think if I was sitting back and I was having this conversation with that person as a client, which, none of this is a recommendation at all that I'm going to talk about, but there are, in essence, three key conditions to a real estate transaction, the way I see it, okay? The first one is income.
Yeah.
So many people buy a piece of property and they do not have income, right? Or return on capital, like the guy put down $220,000, he has no return on that capital.
Right.
Because it doesn't matter how I buy the house, whether I have 100% financing or I pay cash, it's going to appreciate and or depreciate exactly the same way as how you own it. So like my belief is that I've got the income, I've got the growth, and then I've got tax benefits.
That's right.
Right? I don't buy it for one, I buy it for all three.
Correct.
And so many people that I see, I'm going to put down a lot of money on this. And you look at the return of capital, it's like, it's 4 or 5%. It's not that exciting. And
That's right.
Like, if I'm going to have $500,000 and I'm going to put it in real estate, well, if I pay cash, I'm only going to get appreciation off of $500,000.
That's right.
If I finance it 50% and I buy $1 million worth of property and have $500,000, I'm now going to get growth off the $1 million.
That's right.
So now my growth proportion is going to be better. The new big beautiful bill makes the tax law even better. The accelerated, the straight line depreciation versus cost segregation versus the new tenant fit up and all those things. And then qualified business income.
Yep.
But the income has got to return. Like, why would I take $200,000 and make 5% when I can do that in the bank?
Yeah.
Like, why would I do that?
Exactly.
So the real estate by nature should return a larger deal. And I don't think people look at the returns the right way.
That's right. And the challenge is that when they get into the single family rental or they get into the Airbnb, which Airbnbs are a whole nother animal. When they get into the single family rental, for the most part, they also have a lot of additional risk on that capital because, again, if a tenant moves out in that single family rental, who's stuck paying the debt service? Who's stuck paying the bill and the insurance and the taxes and all the things? You are.
Worse, the tenant doesn't move out and doesn't pay you.
Well, both. I've had that happen many a times.
I've heard that happen often.
Yeah, and where with a 200-unit building, if 5 tenants move out, you don't even hear about it.
Yeah.
It doesn't matter.
I mean, you're pricing it typically at a 90% occupancy
92 to 5, yeah.
And if you get it to 95, it's super profitable.
That's
At
right.
90, it's still profitable.
That's right. Yeah. So are the investors in these deals, not only are they completely passive and they don't have to take any phone calls for anything, but they have a diversified risk because you're diversifying across 200 people paying their rent versus one.
Correct.
Right. And there's a lot of tax advantages and other things down the line. And again, I don't like to get into too much of that. You did a little bit, but because I'm not a CPA, I always tell people, talk to your own tax strategist. But look, the administration that we have in right now, love them, hate them, I don't really care. Everybody has their own opinion.
Sure.
However, kicking ass for our business. Right? We are pouring gasoline on the fire right now if you're a real estate investor and you're in the right asset class. Yeah. We've acquired 4 deals so far this year.
Okay.
The first one we bought at a 20% discount. The second one we bought was, first one was 144 units. Second one was 200 units. We bought at a 26% discount. Third one was 248 units. We bought at a 30% discount. And the one we just finished yesterday was 148 units, and it was a mom and pop seller. The dad was in his 80s and died. The kid, his only son, was in his 60s and didn't want to take the property, own it over and manage a property. They owned it free and clear.
So common.
And we're buying it at a 48% discount because the kid's like, I'll just take the 24 million and get out. He don't want to deal with it. So right now with that,
acres of diamonds,
with
wealth being squandered.
But the challenge is that your average person doesn't know how to go find that deal. It's not on LoopNet.
Yeah, but like it's out on LoopNet. But like, who's giving this guy advice to sell it at those prices?
Yeah,
that's frightening to me. So 48% discount, 46% discount, and people are getting bad advice. So there's acres of diamonds. Like you're buying this unit that hasn't been managed properly, hasn't been improved properly.
That's exactly.
And that's a 48% discount on current rent roll.
Yeah,
not what you're going to do to it.
Correct. And that's a 48% discount on the comps in the area. So the comps, the apartment buildings in the immediate area when we underwrite the deal, are all selling at $299,000 a door, $299,000 a door, and we're buying this one at $157,000 a door. Now this was a little different. This one was, we never see these deals, so I'm not saying there's acres of these out there because this just happened to be a mom and pop that bought it in 1999 and they've owned it forever and they've self-managed it and they didn't properly manage it. And so they just didn't really know or understand what they had. And now that the dad died and the mom and the son don't want it, they literally just don't want it, and it's worth $24 million.
It's a lot of money.
So they're like, look, the son's in his 60s, the mom's in her 80s. They're like, we'll take the money and be gone. And they know we'll close, right? Which is a big deal. Most of what we're seeing right now, and this is not going to last forever, most of what we're seeing right now are operators that bought these buildings a few years ago at the height of the market.
Yes, with mezzanine financing.
That's right. And now their loans are coming due. And interest rates are up, so values are significantly down.
And they got to pay down the mortgage.
Yep, and the lenders are forcing them to sell them at a deep discount because the lenders don't care. They just want their money back.
The lenders want their money, and there's mezz money or their money, and their capital is now gone, but they can't afford to pay down.
That's right. I'll give you an example. The one that we just closed in July was a Dallas deal. The guy that was forced to sell it to us bought it in 2022 for $48.8 million, just sold it to us for $33.5. He didn't want to sell that deal.
No.
The lender made him sell that deal. And so with that, with the new tax, 100% bonus depreciation, we got a lot of supply and demand issues that are leveling out and actually coming now back in our favor with demand outpacing supply. We're really in the perfect storm for this right now. But back to what I was saying, people just don't know how to get involved. That's the problem.
Yeah. And like, I look at the opportunity also, and you have a lot of people that have had properties like this for 30 and 40 years that the family has no interest in it, and they just want to sell it. And the greatest transfer of wealth is about ready to happen from the older generation to the younger generation. So I'm assuming there's going to be a lot of this.
I actually a gentleman just flew in from San Diego, one of our investors, and he does some content, and we have a studio in our office, and he did an interview with me 2-3 days ago, whatever. And his name's James. And he asked the exact same question. He goes, I think we're going to find a ton of these because the boomers are kind of aging out of wanting to run this bit. An apartment building is a business.
It's a business.
And they don't want to do it anymore. And I said, I think you're right. We haven't seen it yet, but I think it's coming. And I truly believe that not only is it happening with real estate, but it's happening in businesses.
Yeah.
How many businesses were built mom and pop 30, 40 years ago, and they're just done?
Yeah, they're done. And the kids don't want it. They're doctors or lawyers, and they don't want to, or whatever. They don't want to get into it.
Yeah.
So like you come in and you buy this, like what I'm going to call underperforming asset.
Right.
Do you guys have a formula that you deploy that makes it performing?
We do, yeah. So this was our 61st asset we've acquired. This was our 61st fund. And we come in, we acquire the asset generally at a discount. We immediately go in there and do the value add plan. These are all 80s, 90s, 2000 vintage.
Single building type deals.
No, these are on an average of 150 to 350 unit.
No, I'm talking about like unit, but that's one building.
No, there's generally 6, 7, 8, one apartment complex. But 8, 10 buildings.
Yeah, but like one complex.
One complex.
You're not combining multiple complexes.
Correct.
So one structure at a time.
That's right.
I like that.
Yeah. And these are garden style apartments. They're not your big fancy shiny A-class apartment buildings.
Beautiful.
And B and B plus workforce housing. These are people that work at Intel and they work at the hospital and they work at the chip factory.
Great tenants.
Great tenants. These are working class people. And so what we do is we take this underperforming asset and we renovate 100% of the units inside and out. So we bring it up to brand new shiny, the stainless steel appliances.
How long does that take to do?
We play a lot of Tetris with tenants, so it takes a few years.
I was going to say, it's got to take a couple years.
We go in with 92 to 95% occupancy, so it's cash flowing day one. That's extremely important to start kicking out cash because we pay monthly distributions to our investors. So we want to make sure that cash flow is readily available when we go in. So in the beginning, we're playing a lot of Tetris with tenants, I call it.
Yep.
But we're given incentives, to move into the newly renovated unit and on, and to move out of this one and lease expiry. So anyways, it takes about, I'd say 2 to 4 years with an average of about 3 years to execute from acquisition to disposition. Because what we're doing is we're acquiring the building, executing the renovations, increasing the NOI, and we're selling it as fast as possible. We're flipping apartment buildings.
Yeah.
That's what we're doing.
Yeah. That's what I would, that is a beautiful way to do it. So your average hold is what, 3 to 5 years?
Yep.
Beautiful.
Yep.
Really interesting model.
It's fun. And we work in 3 markets. We're here in the Phoenix MSA, we're in the Dallas MSA, and we're in North Carolina, Charlotte and Greensboro. And they've just been great markets.
How did you I could see, like, Scottsdale, you're here, Phoenix area. How'd you end up in Charlotte?
Ran out of deals here.
Okay.
Yeah. Look, the deal that we just completed here in Mesa, Arizona, that was the first deal we've got to pencil here in years. This market got so saturated and challenging, but yeah, so just forced to go find deals elsewhere.
Interesting.
Yeah.
So your investors are what type of people?
Generally, they're business owners or high-paid W-2.
As you said earlier. Yeah.
These are people that are earning a lot of active income in their business or their job, like I said, and they know that at some point in their life they're going to want to get off the treadmill, right? And so they need to begin taking. And 401k is great and all, but you're trying to outlive your money to outlive you in that scenario.
Sure.
So they need to juice that retirement.
Terrible inherited asset.
That's right. And so
The family that sold for $24 million got a step up in basis. They're like, there's no tax. I'll just
that's
sell.
right.
it. Yeah.
That's right.
Yeah.
Exactly.
Yeah.
Yeah. Well, and that's another reason, right? So these people know that they need to move some of that active income into a passive income strategy. And when they come into our world, we do a full 30-year blueprint for them because everybody's different and they all have different goals and blah, blah, blah. And they all make different amounts of money and can participate at different levels. But we create this blueprint for them to show them every single year. If you invest, as an example, you do 1 deal a year, you do 2 deals a year, we'll do 10 to 12 a year. So we have what we call our season ticket holders that'll come in and they'll say, put me in for $250 every deal you do. Because they're wealthy and they just like, I don't want to think about it. I trust you guys. Just go. And so we'll plug these numbers into a calculator we built. I'll send it to you. It's pretty cool.
Yeah.
And it'll say, okay, if I do 2 deals a year at $100,000 a year, here's every single year what my monthly cash flow will be, and every single year how my equity will grow over time. And then we show them the tax advantages on how to get that cash flow coming into their bank account every month, tax-free essentially, right? Because of the pass-through depreciation that we talked about, and how to build this wealth so that if they 1031 exchange all the way through till the day they die, 30, 40, 50 years later, whenever it is, the IRS steps up that basis if you set it up properly. Again, I'm not a CPA.
Right. So you
And
have a
pass it on to their
structure
heirs
where
tax-free.
that structure would allow the person to do a 1031 exchange when you flip in 3 to 5 years.
Yeah, we
Because I was wondering
facilitate-
how you were like deferring the tax.
We
but
facilitate that for our clients. Yeah. So, and they don't have to. They can take their ball and go home, but most of them, over 90%, 1031 and 1031.
Like a
Nobody
DS
wants to pay the taxes.
like a DST structure almost.
That's right. Yeah, DST. We do a tick structure as well on
Okay,
some of them. Yeah.
cool.
Yeah.
So we're in the fast lane right now, and we're talking about high end real estate with 1031 exchanges and stuff like that. But you've really set up a structure that takes the learning out of the process of real estate. Like your investor who had this piece of property that he was keeping, it was costing him to keep money.
Yeah. That's right.
Like you don't want a piece of property that costs you, even if it's a second home. Like people can get creative with their second homes. And when you mentioned the Airbnb stuff earlier, I was always thinking, who's making the most money in the Airbnb space at this moment? Is it the property holder, or is it the management companies that have figured out how to come in and do it? I think the management companies.
Good question. I was on the phone with a gal yesterday. She was referred to us from one of our other investors, and very successful lady at, owns a bunch of real estate and a bunch of single families. And she says, I'm done managing these things. I want to sell them in 1031 into the passive stuff with me.
Yep.
I'm like, awesome. So I said, I go through this calculator that we created for that. It compares your current portfolio to if you were to sell those and move those over into passive syndications and multifamily. And I said, tell me a little bit about how many properties you own. Tell me what your cash flow is and this and that. She owned, I think, 14 doors or something. And she tells me her monthly cash flow. And I go, holy moly, like you're crushing the average. Like it was thousands and thousands of dollars and the average is like $100 a door. And I said, what's going on here? And she goes, oh, well, one of those is a beach front Airbnb and I make like, $10,000 a month in profit on it. I go, well, that's not, so I said, I would say you keep that one.
Correct. Right? Get rid of the other ones.
Yeah. And all the other ones combined didn't make that much total. Right. So the Airbnb game, I never got into it. What scares me about it is, and look, I know people that have made a lot of money in it, so I'm not knocking it.
Yep, I know
She's crushing it, right? What scares me is there's a lot of regulatory things, city to city, where they, neighborhood to neighborhood, where you buy a house in a beautiful neighborhood or something, and they allow you to do it and Airbnb it. And then 6 months later, after you own it, they say, oh, you can't do that anymore. Well, now you're stuck.
Now you're
what
stuck.
What are you going to do with it?
Now you got a monthly rent, a monthly tenant. And
Right.
That's a whole different thing.
Right. So I just didn't want something that had that much risk attached to it.
That makes really, really, really good sense. So if you're on the, just let's go back and do a little bit of education. Like when you're entering in as an investor into real estate, whether it's your deal or any deal, what are the things that you want to be going over, understanding what's my decision metric on this? Like, how do I not get myself into a trap?
Yeah, great question. And a question that everybody should ask, because people they go in blind and uneducated and they lose money.
Yeah.
And people ask me all the time, that they say, what's the worst that can happen? And I look them right in their eye and I say, I can lose all your money.
Yeah.
I can lose all your money, right? These deals are not risk-free.
Yeah, deals go wrong.
Deals go wrong. Now, knock on wood, in 61 deals, we've never lost an investor dollar. But look, deal 102 could completely lose all your money. And I don't have a crystal ball.
Don't know.
But the couple of things that I would look for being in this game a long time, I like to think of the operator, whoever's operating that deal, meaning whoever's responsible for executing the business plan. Because now we're talking about multifamily deals, right? This is a deal that I am not going to go in and write a $100 million check and buy a 300 unit deal myself and go manage it and do all the construction. I'm not doing that as an investor. I am putting my money into a syndication, my 100, 200, 500 grand, and I am trusting that this operator is going to do what they say they're going to do to take me from A all the way to Z, right? Acquisition to disposition of that asset. And so I like to think of the operator as the jockey and the property as the horse.
Correct.
And that's what you're betting on.
Right.
And I think a lot of people will just hear from a buddy, oh, I heard about this thing and you should get in, and they just trust their buddy and they do no diligence. And what happens with these operators, and the couple of big things that you should be looking for is, and it happened to a lot of them in 21 and 22, and those are the properties we're buying now, is that they got really over leveraged on these things. So you should be looking at the debt structure and you should be looking at the capital stack, and you should be educating yourself and asking all the questions. Because if somebody's coming in and taking 80% leverage or debt from a bank on this deal, there's no margin for error.
Correct.
And if the market tanks like it has over the last couple of years, that lender don't give a squat about your 100 grand.
No.
They don't care. And investors will lose all their equity when the lender sells that deal.
8 or 10, 15, 20 million that we just talk.
They don't care.
They don't care.
They don't care. Investors in that deal lost every penny of their equity. Yeah. And so the biggest thing is, remember, you're betting on the jockey and the horse, the operator and the property. That is number one. You should do your due diligence on that operator. Yeah. How many deals have they done? How many have they taken full cycle and exited for profit? Have they ever lost an investor dollar? Have they ever had capital calls? If they did have capital calls, that's okay, but how did they handle them?
Correct.
What did their other investors say? Right? How long have they been in business? Who are the principals? There's a lot, right? The internet's a beautiful thing. You can find all this dirt.
Find all the open lawsuits.
It's all out there, especially if they've ever ripped anybody off or lost their money. Yeah. Oh, it's out there. Yeah. Trust me. So.
And there's a lot of bad operators out there that and I've been doing this for 35 years. I've seen a lot of real estate deals and some great operators that, 08, 09 was an interesting thing you're buying, but then 10 and 11 became worse because of the runoff. You thought you were buying at these great areas, but real estate is the long game, right? So when you enter the real estate, you're buying undervalued property, which is a specific thing. But somebody's buying that from you. They're now buying full value property, and there's a return that they're searching for that is a mature and a different piece of property. Each one has a specific role.
That's right.
Right. And it's really, to me, if you're going to invest in real estate, even if it's a primary home, you've got to understand the dynamics of the operator, of the cost, of what the appreciation or depreciation is. Like, you bought a house highly appreciated at the top of a market, chances are it's going to take some time.
That's right.
Right. And it's, people get into real estate thinking they're going to quick flip, but paying full value.
Yeah. Yeah. Or just like I meet a lot of people. The next thing is, other than just, I got to go buy a rental, is, I want to do a flip. Yeah. Right. They see all these shows and stuff, and it's great. Yes. And I think that's awesome. But there's just a lot of risk involved, especially if you don't know what you're doing. You're relying on other contractors. It'll eat you alive. And then you go lose $100,000 and you're like, I'm never doing that real estate thing again. Well, you just didn't get into the right structure.
Well, what did you learn?
But what did you learn? You bonk your head on that wall hard enough, you're not going to bonk it again, right?
And you're going to learn different lessons. But I think that, if you look back at when you started in, doing the direct mail to get the foreclosures, what did you learn, right? Yeah. What did you learn, and what did you learn, and what did you learn through the way? And you keep applying that knowledge. You're like, okay, I've been doing this for 20 plus years. Still got to learn something.
Oh, I learn every day.
Right?
Still, yeah.
And that's the ability of an entrepreneur. That's the realization of, this is not an easy game, because if it were an easy game, everybody would be doing it.
Right.
Right. And, I always joke about it, like, when you look at people financially secure, there's a thing called the 100-man story. I don't know if you've ever heard the 100-man story. Mm-mm. So Social Security runs it, and it's basically out of 100 people who enter the workforce in their early 20s, by the time you get to 65, how many of them are financially secure, which means they can maintain their current standard of living throughout the rest of their life. it's less than 1%.
Interesting.
Right. And then you go through the stats, there's a whole bunch of people that are dead, but there's like the bell curve in the center is like 45 or 50 of those 100 people are living on Social Security.
Right.
Below poverty. With all the information, the podcasts and the access to funds and deals, and the mutual fund was created because people couldn't buy individual stocks on their own. So let's pool our money together and create this in the 1930s, right? Like people are not making smart financial decisions, and that's what bothers me most. And it's like those who can look at it and go, how do I structure myself and put money in different places so that when I did a document, the 19 sources of retirement income. Most people have 2, right? If that, like rental real estate is a extremely valuable tool in retirement.
That's right.
In wealth accumulation. But now with, bonus depreciation and all kinds of different tax laws that are impacting real estate, I think it becomes even more valuable. But like things like opportunity zones. Have you guys ever looked in opportunity zones?
We have. It's not the field that we play in, but yeah, there are guys that's all they do.
And the new tax law just completely made that, that whole having to pay capital gains in the 6 years is now gone.
Yeah.
You can defer the gains. You can sell a stock, go into an opportunity zone and defer. But here's the problem that I'm seeing is I had clients who had a warehouse that you had trouble getting, a $9 million valuation. The opportunity zone law came out and they sold it for $26 million.
Boom. I was going to say instantly.
Yeah.
Double,
So
triple
somebody
value.
bought that for $26 million that was only worth $9 million.
Right.
And now they got to go and improve it. How does the OZ zone actually make money? I'm questioning that.
Yeah.
Right. But it's like everybody's running into the same space. And it's like, I get worried that people don't know what they're doing and they're diving into places where they shouldn't be. But ultimately, what I'm hearing from you is it should be a part of what you're doing.
Yeah. That's exactly right.
And how you access it is an important thing. Like there are people doing deals that are just running data centers, warehouses that have data centers in it because that's the growth.
Yep.
But there's a niche, and it's like, what is your niche? And if you're a good operator, not that, I can promise anything on this, the podcast, I have never even talked about any of your deals, so I have no idea about your track record, right? I was more interested in having you on today because I think people need to understand how they can get involved. What does it really mean? And what, if I have money sitting in a place that I have great cash flow that's tax advantage, I have growth, and I'm getting a reasonable return on my equity just from the cash flow, I think I'm in a win-win perspective.
Yeah, I think so. And, they did, I'm probably going to botch this. There's something I read not too long ago, a month or two ago. They say follow the money, right? And it was something about, you may have read the same thing, something about people with over 100 million in net worth. I think they surveyed a bunch of them, and 22% of their assets were in real estate. Yeah. Right. And so when you say it should be a part of your portfolio, your plan, your retirement, whatever you call it, I believe that most people don't get into those types of deals and make it a part of their plan because they're not educated on it. Yeah. And that's really what it is.
And we look at people that have a net worth of $1 million or less, the real estate, commercial real estate rental, beyond their house represents 85% of their net worth, which you can't retire.
That's it. That's exactly right. Yeah, because you want us to live there, right?
Because the math is wrong.
Yeah, exactly.
Right?
And you want us to live there.
Yeah.
So
It took me 40 years to get this house perfect, and now I'm going to sell it and downsize.
Yeah. Well, a house that you live in could be a liability as much as an asset, right? Maybe even more. But that's a whole nother story.
What's your position on the commercial market space? COVID killed a lot of the commercial rental space. Where do you see it going?
I mean, office?
Yeah, office.
That's an interesting conversation. I have some good buddies that's all that they did for many, many years, and they just got crushed, right? And it was so good for so long, and then obviously everybody worked from home. Now, I do believe that there's going to be a large pent-up demand, and this is just my opinion. I don't know. My opinion
Well,
is
that's why
that
you're here, because we want your opinion.
Yeah, my opinion is that, and I don't invest in office. It's
Yeah,
not what
that's
I
why-
do.
that's
We're
why-
very
yeah.
laser focused on apartment buildings.
Which I love.
But I've looked a lot into it over the years and have actually, before COVID, made offers on several with friends and so forth. Just never got involved. But my thought is that working from home, you're never going to get the same work product out of your team as working together.
This conversation on Zoom
It's not the same.
would be nice, but it's not the same.
It's not the same, right? And I think companies are beginning to feel that pretty heavily now. There's an office building right next to ours. We're just a few miles down the road in a really nice area in Scottsdale, and there's an office building right next to ours that a giant company, I'm not going to say their name, they bought this I think it was like 286,000 square foot building. They didn't buy it. They leased it from the whatever. And right before COVID hit, and they were going to move in, they started to build it out, and then immediately COVID hit. It's been nearly vacant ever since. Like they're just now starting to move people back in there. But what I think is going to happen is that you're going to see this massive wave of pent up demand come back. Yeah. Because companies are starting to realize this is not the same. People like hooking their mouse up to the fan over here that's moving their mouse so they can look like they're working when they're really not, right?
Yeah,
If they're tracking their computer screen or whatever.
I logged into my Teams.
Yeah, exactly.
I'm here.
Yeah, and I'm over here like hitting the bong and playing video games.
I've been messaging you for 28 minutes. Where the hell are you? That was a long number 2.
Yeah, and there's no way production is the same. There's no way culture is the same. It just doesn't. It's not.
No.
Period. And let's be honest. At some point, you go freaking stir crazy and want to get the hell out of your house, even if it is to go to work.
Right. And that's why I like all the online shopping that we have. I still think the mall plays a role
Yeah.
in the future because it's the being in a community, being near people, going to the restaurants, I think the lifestyle center is like one of the coolest things ever.
Agreed.
I just think there's so much like the mixing of the uses. I think is really an interesting thing.
People need people.
Yeah.
People need human connection, and you do not get that sitting at home behind your computer screen for years on end. You just don't.
No, there's no tactical stimulation.
Right. That's exactly right.
Yeah, I mean, this has been an incredible conversation. What didn't we talk about that we should have?
I would just ask people to get educated, right? Whatever you're interested in, take the time to get educated. I mean, I'm specifically in real estate. That's where I spend most of my time, and that's where I spend most of my time educating people.
Do you have educational tools available?
I give it away all for free. I don't sell a course. I don't sell anything. Anybody can reach out to my office, and I will jump on a Zoom, and we have very awesome tools that I'll walk you through in about a 30-minute conversation that will open your eyes.
Interesting. How do they find you?
They can find me at the best way they can find me is just going to our website, elevestcapital.com, and booking a call.
Spell it.
ELEVESTCAPITAL.com. Elevest Capital. I'm on Instagram, but I don't do a lot on there. But I'm on Instagram at AW Invests.
Okay.
And I give it all away for free. Whether you work with us or somebody else, I want you to get educated because I'm telling you, you need this.
So the materials that you can send will be something that they can learn.
Absolutely. We'll show them some things that make their head spin.
That's pretty cool.
Yeah.
I'd like to see that.
Yeah. Let's get on the call. Let's meet after this.
I will definitely take you up on that.
Absolutely.
Now, you've been doing this for a long time. Family, you and your wife are here.
Yeah.
You've got kids?
We do. We have 2 kids.
How old?
Ones. A 7 and a 15.
Oh, so they're young.
They're young, but they know more than we do. Just ask them.
Of course. And that'll happen until they're in their mid-20s.
Oh, yeah.
Do you see them coming into the entrepreneurial space?
It's interesting because I would like to see both of them ultimately come in. And my son is really amazing. He's a golfer and he's a great kid, super kind. And he's 15 years old and we got really, really lucky with him. I don't quite see the entrepreneurial spirit in him. Our daughter is 7 and she already has an office in our office and fires people every other day. So I think she's going to be not only the CEO of our company one day, but she's going to be the first female president if they're not careful.
That is unbelievable.
Yeah. Well, she's a Capricorn. See, Capricorns rule the world. That's just what it is.
And Capricorn is what date of birth?
December. Well, she's January, but December and early January.
Yeah, December into early January. I have 4. I have 3 boys, and then I have my daughter. And my daughter basically just is like a laser beam of non-emotion, like it is what it is.
Yeah.
Do this, don't do this. And she's like, I got big, big, big dreams. And I'm like, keep going.
That's awesome. Keep going, man.
It's awesome.
It's awesome. I love seeing that light behind their eyes.
Yeah.
Right.
Yeah.
Good for you, man.
If in a closing, if you if you could pass one word of advice to the listener, again, I know you said like 3 or 4 or 6 in this podcast, but
Yeah.
like the closing argument.
The closing argument is no matter what you're doing, if you're working a job, if you're trying to build a business, if you're whatever, if you got an idea, man, go after it. Go after it because nobody else is going to go after it.
Pursuit of the
Pursue
enjoyment.
it. If you fail, who cares? Like you said a million times in this, what did you learn? You're going to have another idea. The first one might have sucked. That's okay. The second one might suck. That's okay. The third one, you become a multi-millionaire and then come invest in our deals.
I would think that your first deal versus your 5th deal versus your 10th versus your 60, you're approaching them completely differently than you did on the first deal.
Without question. And as we mature, right? As we get a little older, a little more wisdom, it changes.
Yeah.
Your purpose changes too, right?
Yeah.
So
Thank you for being on.
thank you.
And I encourage people to reach out to follow you, to consume what you have and find out what you guys do.
Amazing. Thank you so much.
Thank
Appreciate
you.
it.
This is awesome.